Let's take a look at this stock valuation problem. This one is where we're going to calculate the price of a share of stock that has supernormal growth and then it's followed by normal growth. So you see the problem in front of you. It says that Colgate-Palmolive Company has just paid an annual dividend of 99 cents. Analysts are predicting a 10.6 per year growth rate in earnings over the next 5 years, and then after that they're expected to see a growth rate equal to the current industry average of 5.6%. Okay, now they tell us that if Colgate's equity cost of capital is 8.2% per year and its dividend payout ratio remains constant, what price does the dividend discount model predict Colgate stock should sell for? All right, now first I want to show you the answer if you were to just use mathematical formulas without taking advantage of Excel or an online calculator. All right, and let me walk you through that solution here. Let me slide back up here and we'll illustrate this. All right, so if you lay out the timeline, we have to calculate what the dividend will be at the end of year 1, 2, 3, 4, 5, and then at the end of year 6. So we're going to take the current dividend and increase it by the 10.6% per year for the next 5 years. And then after that, it's going to grow at a smaller amount. Okay? Now, if you wanted to calculate it, what you have to do is take the price per share, which will be equal to the present value of all the future cash flows. So we've got a 5-year stream of cash flows at 10.6%, and we can use this formula to come up with that. Right? There's the supernormal growth period, and then we have to add to it the normal growth period. And you see in this last term here, that model should look familiar to you. That looks like the Gordon dividend growth model. Okay, so if we figure all that out, we can take the present value by taking 1.09, dividing it by the various factors that will bring it to the current value, right? These are all present value calculations, and then that's for period 1, 2, 3, 4, 5, and then in the 6th period, you have to take the normal growth and then apply the Gordon growth model to it. And when you do that, what you'll wind up is 5.28 for the first 5 terms, and then you have to add in it. Now this is, that's the present value of the supernormal growth period. And then you have to add in the perpetuity, which is what this is giving you, that last stream that goes on forever. You'll come up with $50.15. Now, I would calculate this in Excel. And let me show you how I would do that. I've done that ahead here, but let me illustrate that for you. So what I've done is I've put in the rate here is 8.2%. You can also see it right there on the, I call this the formula editor bar. Okay, the supernormal growth was 10.6 and the normal growth was 5.6. That was all given to you. All right, let me expand this so you can see the full word. So if we were to calculate the supernormal periods, we know that period now, which means the last dividend received, was 99 cents. Now we're not going to use this in our formula. We're always discounting the future cash flows. So if we were to calculate next year's cash flow, you take the 99 cents given in value F35 and you multiply it times 1 plus the supernormal growth. That's 10.6%. And once I have that, you can just simply copy that formula down. Now you notice that it's always referencing the 10.6%. That's an absolute reference formula with the dollar before the the column and the row. All right, so there's my cash flows for the supernormal period. But what you have to do is add in to the last period the present value of the perpetuity that will go on forever. So if I hit F2 on this cell, you see what I'm doing is I'm taking F40. Well, what's F40? F40 is the last dividend. Okay? We take the last dividend, and then I'm multiplying that times 1 plus the value of the perpetuity using the Gordon growth market Now, so what I'm doing is I'm saying I have to take the $1.63 we're expecting at the year 5, calculate what the dividend will be at the beginning or at the end of period 6. That's where I'm getting the F40 times 1 plus F32. So I'm taking the 5th year dividend and then saying that's going to increase this time by only 5.6%. And then I have to divide it by the appropriate interest rate, which would be the current cost of capital, which is 8.2%, minus the growth, minus the normal growth that we're expected to see, 5.6. So I have F30 minus F32. And that right there gives us the value at the end of period 5 of all the cash flows that will accrue to us from period 6 to infinity. Okay, assuming we're going to have that 5.6% rate. And the proper way to show that and to discount it is to say, okay, so at the end of period 5 that would be worth $66.54. Then we need to add all those cash flows together. Now again, we're not going to use this 99 cents in the calculation. In fact, I probably should grade this out so that you see that's not going to get used. We probably should grade this one out too. Let me do this the right way. Right, those aren't going to get used. And then what I'm going to do is just use the net present value formula. I'll call this up so you can see what it looks like. I'm simply going to take the rate given in F30, that's the 8.2%, and then that stream of cash flows. Okay, and the stream of cash flows you see right there, $1.09, $1.21, $1.34, through the perpetuity, which represents, again, right here, this represents the cash flows from the end of period 5 through infinity. We have to add both of those together. And when we do that, I come up with a net present value of $50.16. Now, to me, this is an easier way of modeling it than doing the math by hand. Okay? So I hope you found that to be helpful. One last point. I'm showing $5.16 here, and the calculation that was provided by formulas was $5.15. Okay, the difference is simply due to rounding. If you look at how they solved this with the formulas, they only carried out the calculations to 2 decimal places. I went ahead and I didn't round as I went. I just calculated what it really would be beyond pennies.